don't fall into the bear trap of trying to predict a recession based on one signal. Don't miss the forest for the trees here. Take everything as one big puzzle and think of the yield curve as one little piece.
Are we heading into a recession? That might be possible as the ever-important yield curve, which plots the yield of all treasury securities, inverted this week, which could signal a recession. According to Commonwealth Financial Network, there have been 28 instances since 1900 where the yield curve has inverted. In 22 of these episodes, a recession has followed. The last time the yield curve inverted was in 2019, and the following year we entered a recession, though we have to remember that was caused by a global pandemic. So I don't know if that's entirely correlated there. But luckily, to help us out, we have Callie Cox here with us, super investment guru from eToro, who's got her finger on the pulse on everything possible. So why is the yield curve inverting? Help us understand what's going on.
So normally you'd expect a yield curve, and we're talking about the treasury yield curve here, to be upward and sloping to the right. Because if you think about it theoretically, if you're lending money to a friend, let's say, if you lend them money for a year, you'd probably expect them to pay you back plus a little bit extra, that interest rate there. But if you're lending them out money for a year versus 2 years, you'd expect that interest rate to be higher for the next 2 years, just because you're taking more of a risk to lend them the money for 2 years. So anyway, this is what the yield curve is plotting out here. It slopes up and to the right normally, but if you check out how the yield curve looks right now, made a little chart for you, it's a little steep on the front end, and then it flattens out toward the back end. And I know this sounds very nerdy bond market, but this is what the market's focusing on right now, especially the 2-year and 10-year yields, because the spread between the 2-year and 10-year yields briefly fell negative yesterday for, like you said, Nicole, the first time since 2019. So this is important because in this scenario, the 2-year yield might show how much the market expects the Fed to tighten. And the 10-year yield is classically thought of as an economic proxy, where the bond market thinks the economy is going. So investors are putting that together and they're saying, oh no, something strange is happening. People are fine getting paid less for lending out their money for 10 years versus 2. So it's just a strange little occurrence, and the whole happenstance with it happening before recessions in the past really has people freaked out.
Thank you, Kai. That makes a lot of sense. You mentioned the part that I want to talk about is like what has happened in the past has typically been an indicator of what may to come, right? And so the average person be freaking out about this right now because some bond yield inverted or anything like that nature.
Yeah, it's definitely strange, and I don't think you can ignore it. I don't think you can ever ignore when the treasury yield curve looks a little strange, but maybe that's the nerd in me speaking. But seriously, whenever something happens in the bond market, you gotta pay attention. But is it as significant as people are making it out to be? Maybe not. If you think about it, we're in kind of a weird environment right now. I think you could probably agree with that. We have a lot of Fed ownership in the treasury market. We have a lot of international investors looking at long-term treasuries. So people are seeing this recession signal and they're saying, oh no, that switch was flipped. Here it comes. And it's not as simple as that.
What should people be doing? Because they're like, the vibes are off. Like, what do we do?
Vibes are off. I think that puts it perfectly. And that's why you need to take the yield curve with a grain of salt here. I mean, the vibes are definitely off, but other parts of the yield curve look a little more normal. I mean, we'll get a little nerdy here, but my team, the research team I work with, really likes looking at the spread between the 3-month yield and the 10-year yield, which hasn't fallen negative yet. It's actually around 1.8%, so it's very much positive. But we tend to see that invert if there really are signs of immediate trouble. And like I mentioned earlier, too, the bond market is just strange right now. There's a lot of Fed intervention. There are a lot of boomers buying bonds. I mean, I think about my parents, heading towards retirement. They're looking for that capital preservation. So I think it's hard to, derive many smart signals from the bond market these days. So say all that to say, don't fall into the bear trap of trying to predict a recession based on one signal. Don't miss the forest for the trees here. Take everything as one big puzzle and think of the yield curve as one little piece. And, it's hard to predict a recession. So just prepare for the unexpected and don't try to time anything.
Tune in every day and remember to like and subscribe and be sure to hit that notification button. See you tomorrow.